how's it going? This is Mike Morris, Best Life Financial Empowerment Group. Today, this presentation is going to be a quick presentation, but there's a lot of, I don't know, I guess misunderstanding or people are just unaware of what life insurance really is. So I'm just going to kind of give a really brief overview of what life insurance is, all right? So, and I'm doing this because I saw a video the other day from a young lady and a brother named SaNeter, and the young lady's name is Miss Tiffany, and they were talking about life insurance. I just wanted to, kind of give what the real basics are, so that way everybody who's in their audiences can get a true understanding of what life insurance is, at least to get a basic meaning of what life insurance is and the differences between some of the products in life insurance, all right? So again, this title is called The Basics of Life Insurance. It's passing money to your loved ones, all right? And we're gonna just go straight with the definition, all right? Life insurance insures against the financial loss caused by the premature death of the insured. And we'll get into definitions, deeper into definitions. So don't worry. If you don't know what insured is, we're gonna get into it, right? Insurance policy, that's the contract between a policy owner and or insured and an insurance company, all right? The insured is the person covered by the policy. This person may or may not be the policy owner, all right? So you can have a policy owner who's actually the insured person as well, or let's just take, for instance, a husband and a wife, right? The husband might be the policy owner, or the wife could be the policy owner, and they have it on the spouse, right? So the husband has it on the wife, or the wife has it on the husband, what have you. And that's just the way, it can be, right? So that way the insured does not have to be the policy owner, right? You can take it out on someone else that you have an insurable interest for, right? Excuse me. So, friends are not taking it out on friends necessarily, or this person down the block, my neighbor, I'm taking it out on my neighbor, no, right? So the policy owner and the insured, they have to have some type of close-knit relationship, right? Husband, wife, father, son, family, parent, child, something like that. Grandchild, grandparent, something like that, all right? Policy owner, the person entitled to exercise the rights and privileges in the policy, right? So the policy owner, let's go the other way, right? The insured, if that insured person is the policy owner, then they have control of that contract, right? Which is the policy. If the insured is not the policy owner, the insured has no control over that contract, right? It's the policy owner that has the control over it, right? Meaning, is it going to even stay in existence, right? Are you going to keep the contract? The policy owner has that particular right. The benefits, which I'm going to get into a little bit later, the benefits in the policy, who has control of that? The policy owner, okay? So let's remember that. And then you have the insurer, that's the company who issues the insurance policy, right? So I'll just give some examples of some insurance companies, right? You got New York Life, Mass Mutual, Lafayette Life, these type of companies, right? They're the insurer, right? That's the company who issues the actual policy. That's who the policy owner is in contract with, all right? Types of insurance. Now, there's going to be many types of insurance. I'm only going to break down 2 types, okay? And this, I think these are the most, what people have the most questions about are going to be these 2 types. So we have term insurance. That's temporary insurance, temporary protection, because it only provides coverage for a specific amount of time, like 10, 20, or 30 years, all right? That's also known as pure insurance. If the insured dies within the term, the policy pays the benefit to the beneficiary, okay? Now, If canceled or expires prior to death, nothing is payable. So I want you to remember these terms, right? I want you to remember the intricacies of each type of policy, right? If this policy, which is term, is canceled or expires prior to death, nothing is payable. So whatever the amount was, whatever the death benefit was, if it expires or cancels prior to death, that does not get paid out. There's no cash value or other living benefits. All right, that's pretty much simple. All right, now we have permanent insurance. This refers to life insurance policies that build cash value and remains in effect for the entire life of the insured, typically up to age 100 or 121 nowadays, as long as the premium is being paid. Right. So as long as you're paying that premium, that person, the insured, is covered his or her entire life. Okay. So I want you to remember that. That's guaranteed to pay out when that person passes, as long as the premiums are being paid. It is guaranteed to pay out. All right. So again, I want you to remember these things, right? Because when you look at insurance, you have to look at why you're buying it. Once you understand why you're buying it, then you'll know what you should be buying, right? Now, in the area of permanent insurance, you have a few different types, right? I'm only going to go over whole life, but you have other things. You have whole life, universal life, index universal life, yep, et cetera, et cetera, et cetera. I'm only going to go over whole life, okay? Because this is what that conversation was kind of about on this particular program with SaNeter and Miss Tiffany. So I'm going to just go over these two right here. All right. So in whole life, there is cash value buildup, right? So you have access, or I should say you have a type of quote unquote equity in the policy where you're allowed to borrow against, okay? And we'll go into that a little bit deeper. The premiums level stays the same, okay? The death benefit is guaranteed, like I said before, it's guaranteed as long as the premium is paid, and also, the death benefit is guaranteed and also remains level, okay? So everything will stay level, but even that, depending on policy design, which I'm not going to get into because that's a little bit more than the basics, but that can change that particular last part, right? Death benefit remains level. That's a little bit more advanced. The living benefit. The policy owner can borrow against the cash value while the policy, all right, my face right here is in the way. So I'm gonna bring this up. While the policy is in effect, all right. Or can receive the cash value when the policy is surrendered. The cash value does not usually accumulate until the third policy year, and it grows tax deferred, right? So remember that. When you get that whole life policy, typically, that policy will not start to build cash value until third year. And even when it starts building, it's going to start off slow, and then it'll start, building larger as you continue keeping it, right? But again, this is the basics. When you start getting a little bit more advanced, you start understanding what you can do to even change that. All right. Now, what I did was, as you can see, this chart here is from NerdWallet. I was reading a blog on life insurance, right, just to get a little bit of information. So the 2020 average life insurance rates. That's what I wanted to get off here, right? Because one of the things that was on this video, and I wanted to just clarify, is talking about getting $1 million at a particular age, what have you, and passing it on, right? So I want to be clear on what it looks like right now. Of course, this is just a few quotes, right? You can't go by this because this is the quote from that particular, let's see, if you look down at the bottom, annual premiums using an average of 3 lowest prices available in each category for men and women in excellent health. That's key, in excellent health. okay? If you're not in excellent health, these numbers would have been higher, okay? And this is, the source was Quotacy, right? So at that time, whenever this was pulled, for people who are in excellent shape, a male at 30 in excellent shape, a policy amount of $250,000 for a 20-year term is $148 for the year, $220 for 30 years, and $1,829 for whole life for the year. It jumps up, right? But again, there's a reason for it. And that's one of the things people will tell you about, right? Stay away from whole life because it's so expensive. But when somebody says that to you, do you ever ask, why is it so expensive? Why does it seem to be so expensive? And I'm using that word because the word seem, because you have to ask yourself, whoever's telling you, have they run the numbers to see if it's more expensive, right? Just because you see something today doesn't mean that's what it actually is, right? I'm looking at it, it looks like it appears to be more expensive, but over time, is it more expensive? That's the question, right? So we have to look at that. But I'm not here to talk about whether what you should buy, what you shouldn't buy. That's not the question. I just want you to be able to, when you sit down with somebody, when somebody tells you something, I want you to be able to ask the right questions so you get exactly what you want, okay? So even at $1 million, right, and we see it jumps up for the same 30-year-old male. 20 years is $370. For 20 years, $639 a year for 30 years. And for whole life, which is the whole of your life, right? Not a set term, it's for your whole life, $7,123. And you can, so this is going to be recorded, right? You can stop here and compare all of this, right? But again, each individual has a different outcome. Do not use this or anything I say in here to say that this is your outcome. Every outcome is different. You have to sit down with a licensed life insurance agent for them to do a quote for your particular situation to get your price, right? We're just using this for educational purposes so you can just get an idea of what it's like, okay? So I want to just make that clear. All right, so term versus whole, and I don't mean which is better. It's just a matter of we're just going to figure out what's the difference a little bit. We're going to look at it a little bit deeper. Okay, I'm going to use it as a real estate comparison. Term, it's like renting, right? For a monthly fee, you have access to living space, and you have the access to that living space for a specific amount of time, right? There's nothing wrong with renting, right? It all depends on where you are and what you feel like doing. It determines if you're going to rent or buy, right? So I just want you to understand, though, term is like renting, right? You're paying a fee. For that fee, you get a space. For that fee in insurance, you get some protection, some monetary protection in case you should pass away prematurely for a certain amount of time, right? So when your lease expires in real estate, it's time for you to move out. Same thing in insurance, right? When your term insurance expires, that's it. You're no longer covered, right? So you see the comparison, right? From real estate to insurance, life insurance. A certain amount of time for your lease, let's say, I guess the average lease is what, 2 years, right? So after 2 years, time to move out. After your 10 years or 20, 30, whatever it is for your insurance, after that's over, now a lot of times you do have a right to renew. When you renew that lease, it's probably not going to be at the same amount it was the 2 years that you were in the lease, right? They're going to go up in price. They adjust. Same thing with term insurance. When that 10-year, 20-year, 30-year amount is done, you want to renew or you want to continue it on, guess what's going to happen? It's going to go up in price. It's just the way it is, all right? And there's no equity accumulation, right? So there's no cash value. right? So in the home, when you're renting, leasing, money's being paid to pay down the mortgage. You do not get that benefit of equity, right? Only the owner who owns the home gets the equity benefit, right? Same thing with term insurance. There's no equity buildup. There's no cash there, so you do not get that benefit. You don't get to enjoy that benefit. It's just the way it is. This is actually a copy of my policy, or I should say, what used to be my policy. This here started, I just want you to look at, this was a 10-year policy, 10-year term, okay? Year one, see the price. And I was 39 years of age when I got this. So year 1 through 10, right? You can already see it was a 10-year term because, remember what I said, once that term expires, you're going to keep it going, it's going to go up in price. Well, I could have said nothing to you. I could have said it based on that definition. If you looked at my policy here, tell me what kind of policy is it? Whole life or is it a term? Well, you can look at it right here, see the prices for the policy year, and you'll see at year 10, at year 11, it's going to go up. So you can see it was a 10-year policy, right? So, but I want you to see where it jumped. $345 a year for 10 years. Year 11, $5,470. Year 12, $5,870. Look, now it's going up year by year. Year 13, which is what you can't see, goes up to $6,000 and change. Now, I just want you to pay attention now. There's nothing wrong with it. It is what it is, but I'm just showing you. And maybe you'll start to see why term may be cheaper at the beginning, right? Why I said you have to first look over time to see what's more expensive. That whole life that's paying level throughout your whole life, or the term that's paying level for a certain amount of time and then starts moving up as time goes on. I don't know. You'd have to do the comparison yourself, right? Take a calculator, a spreadsheet, whatever you do, you have to look at the numbers yourself. Not saying one is better than the other. It's just showing you they're different. Don't let people compare, tell you, well, term compared to whole life. It's an apple and an orange. You can't compare the two. Yes, they're both fruit, but they're two different types of fruit. They do two different things. You may need both. You may need one or the other. The same thing with life insurance. Term and whole life are two different animals. They do two different things. They're made to do two different things. Yes, they're both life insurance, but they're built differently to deal with a different job. All right? So I'm just saying that so you're aware, and hopefully that'll help you make a better decision on what you want at the time space you are in your life. All right? So still, we're going to continue on with whole life. It's like buying a home, right? Everything I said about term is going to be opposite, right? It's like buying a home. You pay a monthly fee, which is your mortgage, right? To purchase the living space. That's simple. There's equity buildup, right? Equity buildup in your home. So you purchase the home. As you pay the mortgage, as you're paying the mortgage, there's equity in there, right? So let's take $100,000. Let's say, I'm not going to go through let's not go through the whole, down payment, market going up. Just straight, it's $100,000. You paid $20,000 into it so far. You have $80,000 left. So $20,000 is equity, right? You can borrow that equity, right? If you sold the home, the difference between what you owe and and what you paid in becomes yours, right? So if you sold that home for $100,000, $80,000 will go to pay for the mortgage, right? That you took out, and the $20,000 will come to you, right? That's what's in equity. Same thing as the cash buildup. That's how the cash buildup is, right? As you're paying, because the whole life is just like the mortgage. Each payment, if you paid to the end, you would have paid it up, meaning you would have paid the whole amount where you own it free and clear, right? That's what you do in a home. If you keep your home and make all the payments, eventually you own it free and clear. So it's now you just have all this equity built into it that is just yours, right? So it's the same thing with the whole life. You pay, if you were to live to 100 or 121, whatever your policy matures, you'll have 100,000. You'll just use $100,000 as your death benefit. You paid $100,000, and it's basically free and clear. Okay, that's how it works. As you pay down debt, you're building up an asset. So we understand that, right? As you're paying down this debt, your asset is being built up, because the more you pay into it, the more it's yours, right? The more equity you have in it. All right. Cash surrender value. Cash value, right? This is created by the accumulation of premium. It's scheduled to equal the face amount of the policy when the insured reaches maturity date, which is what I was saying, right? If it's $100,000 and you're paying whatever your premium is, if you live up until that point with a maturity, the 100, whatever age of 100, it'll pay out just like the equity in a home, right? So free and clear, right? If the policy is surrendered or canceled, the owner will receive the cash value minus the charges associated with early termination. So you'll receive the equity minus whatever fees or what have you have to deal with, right? It's the same thing when you are dealing with a home. Because somebody will say, wow, I don't get it all back. They're going to still keep some of that cash value, even though I'm surrendering it. I'm canceling it. Yes. But here's the deal. If you did the same thing with your home, you canceled it, right? Now, you sold it, right? When you go sit down to do the paperwork, there's going to be fees. You're going to have a lawyer. Yep. Title, the paperwork for filing fees, right? You're going to have all this stuff that you got to pay for. You're not going to get that $20,000 back you thought you had in equity. Or you might think you're getting it back, but somewhere you're going to have to pay all these different fees, whether you paid it straight out your pocket or you were able to say, you know what, take it out of the equity. You still had to pay it, right? If it came out your pocket, if they gave you $20,000, you still had to pay the fees. Now, people don't count that because it came out of their pocket. It didn't come straight out of the equity, but it came out of something. So you have to account for it, right? So you truly didn't get $20,000 back because you had to pay those fees. Same thing with this, right? The cash value you see, you go ahead and surrender. It's not the cash value you might get, the cash surrender value, because there's going to be fees associated. And it is what it is, right? We just have to deal with that. That's the cost of doing business. So here's the key points. Cash value can be used as collateral for a loan. And I want to get into this right here. This is important, this line right here. A lot of people, including insurance agents, will tell you you're borrowing your own money. Not true. That is not true. That cash value is collateral for borrowing money. Meaning, when you go to the insurance company and say, I want to borrow this amount of money, and you're looking at your cash value, right? Because they will let you know from your cash value what you can borrow up to, right? You're gonna talk to the insurance company. You're gonna say, I want to borrow this amount. Let's say there's $1,000 you can borrow. I want to borrow $1,000. Then you're gonna look back at it and you're gonna notice that the $1,000 you thought you can borrow, you borrowed it, and you're gonna go back to look at your cash value. It's gonna be minus $1,000, right? It's not because they gave you that $1,000. It's just an accounting entry, right? To show you borrowed $1,000 from us. We're holding $1,000 as collateral from this cash value. So you can no longer borrow $1,000 because you've already borrowed it. And then when you pay it back, it rises up. right? So you're not borrowing your money. You're borrowing the money from the general account of the insurance company. They're lending you $1,000 and holding your cash value as collateral. You get a reasonable interest rate, which is set at the time that you start the contract, right? So you'll know what it's going to be like, right? You'll have an idea, and it's going to be very reasonable, right? It's simple interest, right? Calculated on the loan, right? So at the end of that time frame, your annual, your yearly, when they look at your annual statement, that's the word I'm looking for, your annual statement. Towards that time frame, they're going to tell you how much interest you owed, and it's just based on what you have outstanding. It's calculated simple interest, right? It's not compounded or anything like that. You don't have to explain the reason for the loan. You call up the insurance company. Sometimes you don't have to call them up. You go online, go into your account, and say, just type in how much you want to borrow. Again, it has to be within that cash value that you have. Boom. Some of them send you a check. Some of them, they send it right into your bank account. About a day, 2 or 3 days. Done. It's not like going to the bank where you have to explain, this is the reason why I need it. Nope. You have complete control. You have first rights for this loan. Before anything else, you have first right. And as long as it's there, they're not going to deny it. Right? Not unless they thought you were doing something funny with it, but as long as it's it's on the up and up, and how they gonna know if you're doing? Well, let me leave that alone. But it's yours to take, right? To borrow, I should say. There's no credit check. Nobody's gonna say, I need to see your FICO score or anything like that. No income verification. Nobody's gonna ask you if you have a job, right? You are actually the best risk for them. As crazy as it sounds, but they know they're getting their money back. So they don't have to ask you about your credit. They don't have to ask you about your income. You can have no job at that point and still get the loan. That's just the way it is. Okay. And I'm telling you these things because I'm showing you, or I should say, I'm giving you ideas of how to build wealth, how to have access to money, how to start your business, how to keep your business going. I'm showing you how to do these things by showing you the differences in the insurance. Okay? Not saying one is better than the other, but again, depending on what you want to do, you'll know what you need to pick. Okay? If you know you want to guarantee a legacy, then you have to pick the type of insurance that is guaranteed to pay the legacy. All right. Unstructured loan paybacks. What does that mean? You went to the bank. They approved you for a loan. They're going to tell you what the amount's going to be, when you're going to pay it back. And you either agree or you don't agree to it. That's simple. Here, when you borrow from the insurance company, there is no time frame. They're not going to tell you, listen, you need to do this amount per month for this many months. Nope. Until you pay it back. Nope. The statement I'm going to say next is something I hate to say, but I'm going to say it because it's the facts. It's the truth, right? You cannot pay it back. Why? Because like I said, you are not a risk. They're going to get their money back. Whether either you're going to pay it, or when you pass away, your beneficiary is going to end up paying it because it's going to subtract it from what is being paid out. Right? So it doesn't matter. Now, is it a good idea not to pay it back? No, I wouldn't say it is a good idea. It all depends on the situation, because you can get yourself messed up by not paying it back, right? If you let it get out of control. All right. So I always tell people, pay it back when you can, but pay it back. Even if you're paying back a little bit at a time, pay it back, pay it back, pay it back. Because that becomes one of the strategies into building wealth. But again, I'm not going to get deep into that. You can take a look at some of the other videos that I have put out, or I'm going to be putting out, that will show you better strategies of how to use your life insurance. Life insurance should be your foundation. But anyway, let's keep going. This is the one I was looking for here, right? This is also from the Nerd Wallet blog, right? This is why I said from the beginning, depending on what you want it for, you know what you need to get. That's what this chart is about. Now, you can see at the top it says who, and across from that in the middle it says how life insurance can help, and then to the right of that, best option. We're gonna go straight down to the highlights, right? The first highlight, someone who wants to provide an inheritance. How can life insurance help? If you don't have a lot of wealth, life insurance can provide a small inheritance to heirs. Best option, permanent life insurance will pay money for the inheritance no matter when you die. People talk about buying term to pass on an inheritance, and they'll use the number of $1 million because you can get it cheaply. Remember this, you can get it cheaply, but you have to basically die before the term expires. Think about that. If you want to guarantee somebody gets the money, that $1 million of term, you want to guarantee they get the money, you're saying to yourself and everybody around you that you plan on dying before that term expires. Right? I want to guarantee this, but you only have this much time to have it. That means you're saying, hey, I'm ready to go in this time frame. If you plan on living longer than that time frame, then term is not what you want to do to guarantee somebody gets that money that comes behind you, right? You have to go permanent. Why? Because it's guaranteed to pass on. Think about this. You can either pass on less money and guarantee that you're going to pass that on, or pass on money, try to pass on more money that you're not guaranteed to pass on, right? You have to make that choice. That choice is for each individual. You pick and choose what you want. I'm just giving you the basics of how it works. Let's go to the next one. An investor who maxed out other entire retirement plans. How can life insurance help? Life insurance with a cash value component can provide a supplemental source of retirement savings. Best option, we already know what it's going to be. Permanent life insurance builds cash value that you can access. Retirement plans, supplement your retirement plans, permanent life insurance. You want to guarantee to pass on an inheritance, permanent life insurance. You want to just have something just in case for a short amount of time, term. Like I said, there's nothing wrong with term. But you take a look at this chart that Nerd Wallet put out. You take a look at it, and you figure out what is it that you want to do. Then you just look through the other columns and say, okay, this is what I want to do. I'm a breadwinner. Life insurance can help replace the lost income so your family can continue to pay everyday expenses. Term life can cover your working years. But again, remember, if you live past it, you can renew it. Are you prepared? You have to ask one, are you prepared to pay the new amount? Right? And two, you want to guarantee the fact that they get it. Right? That'll let you know if you can pay it. If you know you want to guarantee, maybe it should be the other way around. Do I want to guarantee that they're going to get it? Yes. Do I want to pay this amount? Yes or no? That'll let you know, should you buy the term. Maybe you have to buy term at the beginning until you get yourself established, and then you switch over to whole life. I don't know. But you have choices. Make sure you sit down with a competent life insurance agent, not one that's biased to one or the other. Okay? Let's talk. Listen, I tell anybody you can give me a call. That's my number right there. All right? That's my number there. That's my email address, bestlifefeg@gmail.com. All my social media is bestlifefeg, whether it's Instagram, Facebook, Twitter, YouTube. I'm going to be putting out more videos on getting a little bit deeper into how to make life insurance your foundation to build upon. Okay? Especially in my community, we don't talk about life insurance enough. We don't understand a lot of the times how to build life insurance. I speak to a lot of people, especially family members, friends, that look just like me. And you ask them, hey, I'm gonna buy some life insurance. What should I do? Don't buy whole life. Buy term, is cheaper. Listen, it may be, but nobody asks me, well, what do I want to do first? What's my plan with this life insurance? Nobody asks that question. They just tell me what not to buy, what to buy and what not to buy, without asking me what is my purpose for buying it. I am a licensed life insurance agent, okay? My home state is North Carolina. I'm licensed in New York, Virginia, another state, I think another 2 states, but I am licensed. Give me a call, ask me questions. I have no problem answering questions, okay? But I just wanted to put that out for SaNeter and Miss Tiffany, because I like the fact that they were talking about finances. They were talking about life insurance, right? You don't see that a lot, but I just wanted to make this video to just give some clarification so people really understand what it's all about, all right? Again, my name is Mike Morris, Best Life Financial Empowerment Group, and what I always leave, or try to always leave in all my videos, if you know what's going on, you'll know what to do, all right? Peace.